This week, I want to keep it simple and give you a few things to watch for the remainder of the week and into next week. Drawn here is a Fibonacci retracement on the USO, which is the ETF that tracks the performance of the spot price of crude oil. Um, Before I give you a few things to watch for in the USO, let me just quickly touch base on what's going on in Greece and just give you a reality check really. Most people pin recent weakness in the broader markets on the no vote coming out of Greece over the weekend and the non agreement so far between the Greek government and Troika. The reality is that one has nothing to do with the other. The current crisis in Greece, as it's being, you know, told or sold really in financial media, is just that it's being sold as a financial crisis when it's nothing more than a political crisis. Unlike 2007, 2008, where there was a banking crisis, where no one bank knew how much risk they had with another bank, what the counterparty risk was. Today, that risk is simply not there. All Greek banks are supported through the ELA program by the ECB and through various loans issued by the IMF or other government bodies. So, in the event that Greece were to exit the EU, no one bank or group of banks are threatened of facing stiff write-offs in their books precisely because no one bank has given a loan directly to Greece. Now, what should be noted is the fact that at the very beginning, dating going as back as the inception of the EU in 1999 to 2000, banks were the original originators of these loans to these governments. It wasn't until after the financial crisis between 2007 and 2008 that banks sold these loans to these international organizations such as the IMF, so that they basically, the banks were essentially off the hook for any of these loans should any of these loans go into default, and the risk was essentially given off to different government bodies. This is very important because the risk of contagion is therefore eliminated. There's no risk of any one bank being undercapitalized or facing the possibility of being liquidated because it's being threatened by any one government or group of governments. So, because the IMF and other international organizations are are the holders, not the originators, but the holders of these loans to all these governments, they essentially are backed by the people, and that's a problem. What we see is simply a shift of liabilities or obligations from the private sector to the public sector, and the public sector is issuing more debt that it can possibly repay at a future price through time. When again these government entities have no care and really no intent to pay any of it back. So, in the event that Greece were to exit the euro, yes, those loans that were going to default, the people that are ultimately the holders of those notes, which are uh, credit holders, right? They will have to assume a loss on or take a loss on those bonds. The problem is that these international organizations are not going to simply just walk into the night and assume 60, 70, 80, even as high as 90% haircuts or losses on any one of these loans. Much less are they going to forgive Greece or any other government for that matter for any one loan, even though that was the case, or what happened with Germany back in 1953, when most the countries, including France and the United States, forgive Germany for most of the loans it owned to the international community. But what I want to bring your attention or focus your attention here is very simple. Greece has nothing to do with what's going on in the market. It's being used as an excuse or being sold into as you to you as the reason why there's broader market weakness. The reality is that the market is being held captive by a consortium of entities that are willing to push the market slower for no good reason, just to make it seem as though a Greece exit is in the worst isn't the worst is the worst possible thing that could possibly happen to the markets, citing it as a financial as a risk of a financial contagion. Again, there's no contagion to be had whatsoever. Again, those liabilities have been transferred to international organizations, which are backed by governments, and in essence, those governments are not backed by anyone but its people. And since that's the general mindset, there's really no effect to be had here. Now, in the event that Greece exits the European Union within a week or within a month, the initial reaction will most likely be a sell-off in the broader markets as people perceive the EU to become essentially weaker and begin to discount the possibility of other nations such as Portugal, Spain, and even France possibly exiting the euro. But again, that risk of contagion is simply not there. So with that said, recent weakness can be attributed to the recent sell-off in the price in crude oil and to the sell-off seen in the Chinese stock market. Even with today's rally, you have to call into question the overall composition of the current market. Yes, I mean the market came back from almost being down 20 points in the S&P to ending up 10 points. I mean, at around 6:30 in the morning, the S&P was priced to open close to 15 points higher where it closed yesterday. Towards the open, it was only up a few points, traded as low as 204.11 on the spiders, before bouncing back towards the end of the day and ending at the highs of the day, closing up about 10 points. I mean, the last time we saw such a wide range in a 24-hour time span was back in October 2014 when you saw a massive liquidation break in the U.S. stock market. These reversals are again are welcoming sign if you're trying to pick bottoms in the market, but they're not. They shouldn't be taken at face value, and the reason for it is very simple. The weakest sector of the market, which is the Dow Jones Transportation Index, is still trading below or setting a base at a lower price point from the previous base. A couple of weeks back, I mentioned how a breakdown in the IOIT was more likely not going to carry over to the S&P 500. I also mentioned that if a breakdown were to occur, the breakdown or the pullback in both the IYT and S&P 500 was going to be orderly as opposed to being a disorderly breakdown as we saw in October 2014. The reason for it is fairly simple. Today, we're still seeing money being shifted or allocated within the equity sphere or routine stock markets around the world, and it's not just a flight to safety or a capital flight to safety, as we saw in 2014. Again, this market is not, again, the market or the smart money, call it as you want, knows that there's no risk whatsoever of contagion, even if Greece decides to leave the EU. This is more of a show me market where you're getting it pushed lower on the perception that if there's no deal coming out of Greece, that this could potentially be a negative, not just to the market, but to corporate earnings. When again, one or the other has nothing to do with one another. So for me to feel a little bit more optimistic about this market, I'd have to see the IOT trade back to the previous range and begin to prepare higher prices shortly thereafter. What I've drawn here is an accelerated uptrend from the 2014 gap up following the October low through time. As you can see, we're trading below this trend line, which means the short-term trend, bias, and momentum of this market is still to the downside. Until this reverses, which is going to take some time, at least in the IOT, there's no reason to be bullish in this market. But at the same time, it's not a reason to be overly bearish, not unless we can test today's lows in the S&P 500 again around 2060 and break convincingly lower. If you look at the XLV, which is a leading sector more or less, it's the same story. We're still trading below the accelerated uptrend dating from the October 2014 gap up point through time. This one, it's acting a little bit better. It's still trading above a higher low, but again, the bias and momentum is still negative, even though the short-term uptrend remains uniformly to the upside. So what I'm trying to say is this: for the S&P to have any possibility of trading back to where it was just a few weeks back, around 2110, 2120, it would have to come off the backs of a stronger leading sector such as the XLV or the IBB, and also strength coming out of some of the weaker sectors such as the IYT. If this happens, as we volatility compresses, then and only then could you begin to really pick bottoms in some of the stocks you like most, or even chase some breakouts and draw different trends or trades accordingly. Until then, and as long as volatility remains fairly elevated, you have to be very, very careful in this market, because what we've seen is a change in trend where traders are now buying volatility, or excuse me, selling volatility on the shorter end of the curve at the expense or of buying volatility at the longer end of the curve. And not just for volatility, but for individual names as well. So unless that changes, it's very hard for you to, or for me at least, to see this market trade appreciably higher in the very near term. Um, if you're somebody or someone who's risk averse, I would definitely recommend you take the month of July, or most of it anyways, off, and let the markets sort itself out, and come back in August uh, or into early September and reassess market conditions then. Like I said, this is promises to be a very volatile summer, especially as we near earnings season. And unless you have a strong stomach and can weather these volatile day-to-day swings, you're better off waiting until August to make a move.